National Home Value Index rose by 0.7% in July, marking a fifth consecutive month in the recovery trend to date.
Hey guys, thought I'd chime in with another video on the state of the property market based off the CoreLogic report, which they put out on a monthly basis, I think. And to be honest, it kind of feels like not much has happened, but there's also a lot happening at the same time. In this video, I'm basically going to go in and have a look at that. I'm going to look into the supply and demand factors, mainly in Melbourne, where I am, but I'm going to highlight the fact that the two-tiered economy is back. I don't know if you're aware of that, but 5 years ago, pre-pandemic, two-tiered economy was a thing. It was Melbourne and Sydney basically versus the rest of Australia. Today it's like that, except the dynamics have basically flipped themselves on its head. So let's get into it. All right, so the first thing that comes into my head is the actual listings, because that's the supply on the market. And to be honest, it's one of the things that is kind of the topic of the news. Like listings, whilst it's not said specifically, if people are talking about the mortgage cliff, it's kind of built in that, all right, if the mortgage cliff is coming, people are going to be forced to sell, therefore the listings are going to go up, and that's going to increase the supply in the market. That's kind of where I look at first, and it's actually really interesting. I suggested a two-tier economy earlier, and if you look at the listings based on the equivalent period last year, Melbourne's pretty much the same, so it hasn't moved. Sydney, there's 10% extra supply on the market. I just want to touch on the rest of the market at the moment. I mean, look at the decrease in listings from 12 months ago. Like, it's absolutely massive. That is a meaningful amount. So you can see here, you know, if something's down 15, 20% on listings, it suggests to me that there just has to be more demand. So potentially those places are booming, and I know some of those are or have been booming. So supply is still tight. Let's look into this email from CoreLogic. So it's basically highlighting the fact that there are a large amount of listings. This graph here shows the amount of new listings that have been basically put on in the winter period. It tells the same story, but it tells it from a different angle. So you can see here that Melbourne and Sydney, based on the 5-year average, there's actually been 22 and 25% additional listings in winter. That to me feels like an alarming number when you look at it. And it kind of is. So I look at that and my first thoughts are, okay, well, if that's the winter listings, does that mean there's going to be another 25% more in springtime? Because if we keep getting numbers like that, eventually the supply is going to outweigh the demand. You're going to get the market starting to heavily discount the price of property, meaning property market goes down. You also see here, it just tells you the story of the rest of the states as well. Less listings, assuming there's equal demand and less listings, it's obviously better if you own property or if you're a property investor. So one thing I want to point out in terms of supply, and this is why we really need to bring it down to city by city and even chunk it down to market by market, because this slide here, you can see the listings on a national basis. So it appears on a national level that, listings are decreased. The red line is 2022, so we can see that it's actually on a national basis less listings in 2022. But the peach line or salmon line or whatever you want to call it is the average over the last 5 years. So there's a lot less properties on the market over a 5-year period. That is on a national level. If you go to somewhere like Melbourne, actually, I think the figure was it's basically at the average level. And I guess it's a broader point of just be careful, because the numbers tell you a story, but it doesn't mean that story is the absolute truth. So it always pays to dig a little bit deeper when we're looking at I guess you'd say, database approach. So now we're just going to look at the demand side. We're just going to look at a couple of ways of looking at the demand side. Obviously, supply and demand, you can cut it up into so many different ways of looking at it. But the immediate thing that comes to mind to me is the growth in credit, because let's be honest, the housing market is driven by the credit market, the ability for people to borrow money, and there's no hiding we're at rates around 6%. A couple of years ago, we were at rates around 2%. Actually, if I had just thought about that without looking at the graphic we've got on the screen, I would say there'd be a lot less lending than what we see at the moment. The graph actually just shows us that it's just gone back to its pre-pandemic high, And if you look at 2019, it's actually well above the lending. So it's actually bounced off at the start of this year, which I wouldn't have thought that would have happened based on the fact that interest rates were still rising at the start of the year. So interesting to show us that the demand hasn't completely gone away when it comes to what's shown in terms of new commitments, new loan commitments. So that's not a bad thing for the demand side of the equation. So when we look at property, you're looking at supply and demand. We can make assumptions based on the graph that I've previously showed you that supply is going to continue to increase, and that makes sense because we're coming into the selling season or the buying season. Spring is traditionally when vendors want to get their properties ready because obviously the lawns look nice, the sun's out, and the buyers are also out. It's going to be interesting to keep our eye on the supply. The demand is not looking too bad in terms of borrowing power. The other thing you can do to look at demand is look at days on market. And I'd really like it if they chunk these graphs down to basically by city, but this is kind of, they've done it as capitals versus regionals. So it's days on market. So if you list a property for sale, on average, how many days does it take to sell? If that's increasing wildly, it tells you a tale that property is becoming harder to sell, and the longer the days on market goes by, the more likely the market is going to start discounting. If we had this graph, and this was for Melbourne, for example, the combined capitals, it would actually tell you that things aren't too bad. I mean, 28 days on market as average isn't too bad historically, but it's something to keep a watch on, obviously, because the days on market, the trend from kind of the last 12 months has been that it's increasing, and regionals is the same thing. The last thing I'm going to touch on is interest rates. I actually have this conversation almost on a daily basis. I was chatting to someone today and they're bullish on property because the rates have been paused. And whilst I agree that there's a lot more positive sentiment and that can short-term overflow into the market, the property market will increase, I would say that's potentially a short-term look on the property market. And the thing I caution all of my clients about, but everyone about, is we don't understand what the impact of higher debt levels are. My point is that kind of 15 months ago, if I told people that their rates were going to increase from 2% to 6%, I just would have been laughed out of the building. But here we are, and a lot of people are in pain. In terms of investing, sure, property is a great investment if you can hold it for a period of time because it inflates with the money supply, which is ever inflating. My word of caution is that if you don't have the cash flow to pay the higher interest rates and you're forced into a position of selling, maybe that's not beneficial, or it's not going to get you to where your goals are, and you're going to be put into struggle town and suffer. I'm not saying that people shouldn't do that. I'm saying what they should do is consider what would happen if the rates went up to 8% or 9% on the next cycle high, because right now there's a lot of people in the position that might hold one or two properties. They were positive 12 months ago. Now they're leaking some serious cash flow, trying to pay those investment loans off and also trying to pay their home loan down. And what's actually happening is their overall debt is just remaining higher. So I'm not saying that holding or selling is the right or wrong thing to do. I'm just saying that out of all of the thousands of years debt has been around, debt is the number one thing that wipes people out financially, because they don't have the income to be able to make the debt repayments. And if that's the number one risk, we should be looking at that as number one risk. The last 20 years, I would make the suggestion that people haven't been looking at rising interest rates as a number one risk. That's all I'll leave you with. A bit of a word of caution. I'm a bit of an old man these days. So sorry for the skepticism, but I feel a healthy dose of skepticism is what's needed in today's day and age. If you've got any questions or you need help with finance, please get in touch with us. Cheers.